is going on, fam and friends? We have a special episode for you, so we might as well get into it right now. It's Monday. It's Mark Pires. I was walking down the road and it's Renaissance Man. I'm here to ease my mind and help my living. It's Renaissance Man. It's daily variety show Mark Pires Renaissance Man. I'm here to connect with you, to amplify your current state, and I'm here with you on day 1176 in a row of the Renaissance Man Show. We're going to get into it just like we do every single day. Today's just a little different. We have an interview today, guys. Very excited about this. My friend, Jason Arena, he's actually here right now, so I'm going to get us going on the Zoom. See if we can get Jason in as well. Jason, my brother, can you hear me? We're going to have to get our woohoo later, guys. Jason, you there?
Hey, Mark.
Hey, buddy. How you doing?
I'm great.
Let me see if I can get you to, I'm going to click over and ask you to start the video if you can. Let's see if that works.
Yep. 1 second.
I'll start mine too. There we go. There he is.
How are you, Mark?
I'm doing great. Look, guys, Jason's sitting there. This is what I'm talking about. We're going to have a real estate conversation. He's showing us his pimp place right there. He's kicking it waterfront. How you doing,
Nice to
buddy?
see you.
It's good to see you too, bud. So, guys, I want to quickly give you a little introduction how I know Jason, and then we'll go from there. So my wife and Jason work together, and Jason's a great guy. And at a certain point recently, he called and said, hey, you know what? I want to pick up another property. And this is why my mind starts going, and I start thinking about people who are doing things, shaking it up, and how that could help you out there. So Jason picked up a property. And now, Jason, how many do you own?
7 different properties right now.
7. Okay, this is huge, guys. What I want to see if Jason can walk us through today with is how do we kind of get started? If we want to pick up our first property, what are safe properties to look into, locations, etc. So I think Jason owning 7, he's got it down. So maybe we'll just let him talk and give us a little advice, and I'll just pop in every once in a while and just ask you a little thing here and there. If anybody in the chat has any questions, throw them out there, and I'm sure Jason will do his best to answer them as well. So what do you think, buddy? If we wanted to get started, obviously we're going to prospect. We're looking for a property first and foremost. We have a little cash set aside, or even, how does that work for first and foremost? How much money do you have to have? If you said, hey, you know what, maybe I want to put it towards real estate. How much money do you have to have kind of sitting around in order to think that way?
Well, you can potentially acquire a property with a fairly insignificant amount of money, 20, 30, $40,000, depends what your geography is, but you can acquire with low money down. It depends on your circumstances. So we can talk about one of those scenarios, but I'll just mention at a high level, I think real estate is probably the best major asset class. So when I say asset class, referring to stocks, bonds, cash, and real estate. And that's on the basis, in my opinion, that leverage is used, that debt is used. In other words, that you have a mortgage. Very few businesses have the potential to generate the type of cash flow with the durability and consistency, I would say, that real estate can. And there's a number of structural benefits which we can talk about.
So when you say that too, so the benefit of it is it's guaranteed. So with stocks, for example, if you were talking about investing, that's going up and down. But when you lock in a lease, that's there for the full year, or for the term, you have that at least guaranteed. So is that what you mean, that it's always going to be there?
Well, I don't use the word guarantee, but I think that if you look at the economics of purchasing a property with leverage, they're very compelling. And I'll give you an example of that in a moment. But One thing I wanted to, people always ask me all the time, what's the best kind of real estate to buy, single family? Because there's a lot of sub asset classes within real estate.
Mm-hmm.
So you have, there's self-storage, there's industrial, office, retail. There's lots of different kinds, right? For purposes of this conversation, and I think for 95% of small investors or mom and pop investors, I think multifamily, and when I say that, I'm referring to a 2, 3, or 4 unit property. I think that is the best way to get started. If you're kind of into the millions, into 8 figures, I think that changes. Commercial makes sense, but let's just assume that we're talking about multifamily real estate, 2, 3, 4 unit properties.
Okay, so that would be the first buy. You would say instead of someone going out and buying a single family home and just renting that out, they're better off going, if they're going to try to invest, their first piece should be a multifamily, a duplex, three family, etc. But that would be the first thing to start with in order to really broaden your horizons for the next opportunity.
Right. Well, with a single family home, I do own some single family homes, and there are benefits to those homes versus multifamily. For example, if you own a single family and you get a renter in, there's a reasonably high probability that they are going to stay there for an extended period of time. They are oftentimes responsible for the grass, for the snow, for basic maintenance, and they're often there. I mean, in the US, a lot of people, where they live is based on the school system. So if they get kids into the school system, you could have a tenant in there for 5 or 10 years. And that's fantastic for the landlord, because there's the turnover costs are reduced and vacancy costs are reduced. However, the economics of a single family can be very tough. If you do the analysis, you have one roof and one driveway, right? But if you look at a 3 family, it's really, really difficult to see the similar types of return or the same types of return as you can get on a multifamily. The other thing with a multifamily is people are willing to pay, not necessarily based on what rent it would generate, but people are willing to pay for a single family home what they believe it to be worth. And where they're going to be comfortable, where they want to live with their family. And there's no real limit on that kind of dynamic, where again, looking at a 4-unit property, that is going to price to a large extent based on the rents. So it's tough to sort out a single family, but
so you're for a single family, if you can find it in a great school location, you get a locale, walking distance to the restaurant, something like that. A single family could be lucrative, but your better cash flow opportunity is a multifamily.
No doubt about it.
Okay.
Today, where the average single family home in the United States, I believe, is now valued at over $300,000.
Wow.
If you just purchase a single family home for $300,000 and you make a 20% down payment, sort of the standard down payment, chances are it's not going to cash flow. After you pay the mortgage, the taxes, the insurance, and assign a cost for vacancy, chances are it's not going to cash flow. But you might be able to do that in a 3 or 4 unit.
So when you say a cost for vacancy, so you have an anticipated amount of time where you assume it's just not going to be rented.
Right. And that's an assumption. So just based on every financial model in life, you have to make assumptions.
Yeah.
And that can be anywhere from 5% to 10%. I'm very fortunate with some properties. I have situations, I haven't had a vacancy in years. Other times, if a unit's in good shape, you can have a vacancy. Someone leaves at the end of the month, you can have a new tenant in the next day if no major work is required. But other times you could have a 3-month vacancy if you need to do serious work or even light renovations. And during that process, it's tough to market. You may not have photos.
Yeah.
So you have to kind of assign a vacancy cost based on the particular property, I think that you invest in.
See, that makes sense. These are the things I think people need to realize when you're getting in, that there's lots of risks. So you have to go into it with that factored in. It could theoretically not come to fruition, but you need to be aware of those potentials. And 10%, whatever, that could wind up being a serious amount of money. So you always have to have a nest egg aside to cover those downtime, so to speak. It's interesting you say that. I have a client who rented a place for 12 years. And then they were like, we're going to buy. I was like, 12 years you've been renting? You know how much money you threw out the window? And you could have been like equity into something. But I think people learn that as they go, obviously. I think that owning property to me seems like it makes the most sense, especially what I hear a lot online is this BRRRR method, which I think I've mentioned to you before. And it's like they say, okay, you buy it, you renovate it, you rent it, then you refinance it, and then you repeat. And you keep doing that over and over and over. And like, you've done that 7 times. I don't know if you refinance to do it, but that's how these models are made. These people, some guys like, hey, I started one, now I own 260 because I just kept buying, renovating it, renting it, rinse and repeat. That to me seems like you could build yourself a pretty crazy, career or an income, passive income for yourself if you can get that process started. To me, I think the first one is probably, it's like everything else in life, is getting that first one to get going in order to get the confidence to take a stab at another.
Yeah, absolutely. I would say it's tough to get going. You get much more comfortable. The first house I bought, I was so nervous. I remember asking the property manager, I said, what if you can't find anyone to rent it? That's not a question I would ask now. It's you can always find a renter. It's really just a function of cost. So the question would be, well, might we have to lower our asking price versus our assumptions? But yeah, to your point, Mark, once you get going, things get a lot easier, but it is tough to break the seal.
Yeah.
But with respect to, you mentioned passive income, there's sort of 5 verticals or 5 key pillars of real estate investing that I think about. So the first one is the single most important in my view, which would be cash flow. So how much cash flow can you generate from a particular property? The next, and in no particular order at this time, would be appreciation. That's the second one. You have tax benefits such as depreciation, and you have equity creation via mortgage pay down. And then number 5 would be, it's an inflation hedge. So those are 5 key economic pillars to real estate. And the last one I mentioned, inflation, is kind of interesting because right now we're seeing 35, 40, 45-year highs, depending on what you look at in terms of inflation in the United States and even around the world. So if you are a landlord, it's a great time to be a landlord in many respects, unfortunately, because housing is becoming less available, less affordable, I should say. We have a housing shortage. And when leases come due every year, you can increase the rent to reflect inflation. So my costs of insurance are going up, my maintenance costs are going up, my taxes are always going up. So it gives me the ability to adjust my rents in a manner that is, helps me, defend my margins. I guess I could say, like some businesses have pricing power, some have less, some have more, but I think it's compelling in real estate. It serves as a great inflation hedge.
Now, if you were going to buy a property, would it be a good mindset to say, hey, you know what, if I can buy it and then have someone in there just paying it off, like paying off that mortgage, and that's good enough. I don't have to make a penny more, but as long as they're paying it off, is that a good investment, or do you think you should be making something on top of paying off that mortgage with the rent?
So you're referring to purchasing a property and basically your cash flow is break even.
Yeah, exactly. Is that still a good deal, or do you think you should be, what kind of percentage would you say, or like you're doing well at X percent?
Okay, that's a good question, but it's hard to answer. So different properties, you're going to want to see different levels of cash flow with different properties. So, for example, the very first house I purchased was brand new construction. And I knew that my maintenance costs and my CapEx costs were going to be very, very low. And I was, of course, paying up for that. So my cash flow was low, but it was okay. Now, I think the fourth property I bought was basically a total dump. It was a full gut renovation. And as a result, I knew I needed to generate some fairly serious cash flow to pay for that renovation and pay for all those improvements that needed to be done. So to answer your question, it really depends. I would say it depends on your circumstances, but also you want the property to carry itself. Otherwise, you're probably better off just going into the stock market or something. So if something costs you, let's use easy numbers. Let's say something costs you $1,000 a month to own. That's mortgage, taxes, insurance. You still have to have some type of maintenance factor rather. So even if that's very small because the property is in good condition, that can be fine as long as the numbers work. And to your point, you're still making money by paying down by having someone else pay down your mortgage. So it can make sense.
So break even would be okay. Just if you have to come out of pocket at all, then it doesn't make sense as an investment. You're better off putting it into the stock market. You don't want to ever have to be coming out of pocket while you have a tent in place.
You probably not. No, I mean, there could be circumstances where it makes sense. But for the most part, you want to see positive cash flow. And these things, I mean, the costs are always probably a little higher than you think they're going to be. So you want some cash flow coming in.
You know, a couple questions that came in over here. I'm seeing Sarah is asking about beachfront property. I always think beachfront property would be a good investment. She was asking if it is based on the fact that everybody wants it. And William had asked where in the United States are good places to invest in real estate. I don't know if you look throughout the United States, probably not. I don't really, but you may know of a couple areas that you're just thinking, hey, you know what, if I was going to get out of Connecticut or New York, I'd probably get into and buy in these areas. I mean, I saw a guy, I think he was looking in Ohio. He was buying up places around the colleges and he's just cleaning up. If you can go into university areas, I would assume you're doing well, right?
You can, yeah. So to answer the question about beachfront property, admittedly, it's not something that I've analyzed closely, but I think, of course, it's compelling to own something so desirable and kind of something that could be more of a trophy asset. But you have to do the analysis you're probably thinking more along the lines of a VRBO and Airbnb. If you purchase beachfront property, you also have to think about insurance costs, which are going through the roof and will probably continue to for some time. The pandemic created so many supply chain issues, right? And just the cost of material went through the roof.
Yeah.
Cost was going up. So as a result, homeowners insurance is going up. But add to that a beachfront property where there's all the risk of some type of natural disaster, and you're probably talking about very serious insurance costs. The condominium collapse in Surfside, Florida had a massive impact on the market as well, and I can't speak to it in detail, but it also, I believe, influenced insurance costs. So beachfront property, really interesting. You have to do the analysis and see what type of rents you can generate off a short-term sort of VRBO platform.
Yeah, and I think, and this goes sort of to my fears about where we're going in this world, but I don't know if I'd want to invest in beachfront property for the long term. We may be losing some land coming years with all the, what's going, glaciers are melting. And at a certain point, we lose some sort of the shoreline, and it just recedes a little bit. I used to joke with Laura, I'd say, we're going to be waterfront in 50 years, because something's going to happen and all of a sudden it's just going to rise. So I think a good location would be by universities or by a downtown area where people, or by a hospital, right? Wouldn't you think by hospitals are a great place to have rentals? Because you have people who are doctors who want to be able to rent nearby.
Yeah, so to answer the second question, when I first began this process in really 2012, 2013, the way I started was I looked at the entire United States from the top down. And I researched employment data, population growth, demographics, all these things. And I ended up starting in Dallas and Fort Worth. That's where everything looked most compelling to me. So being at the time I was living overseas, so I was sort of agnostic from a geography perspective domestically or in the US. Mm-hmm. But that's a whole other conversation with respect to, do you want to invest long distance or locally? There's a really compelling reason to stay local, even if you don't live in the most attractive market.
Yeah, being able to check on your properties would be one. Is there something you can speak to for about 2 minutes? The dog is outside and I hear him freaking barking like crazy. I gotta go get him inside real quick. Talk quickly about how the challenges of owning a property in Texas, and how you manage that from here. And I'll be right back in 2 seconds. Okay, hold on.
All right, man. So yeah, to answer Mark's question, owning long, so I live in New York now. I'm back in the United States. Owning property long distance can be tricky. The properties I do have are single family. So as I mentioned earlier in the conversation, single family tenants tend to spend longer periods of time in the property versus multifamily. So less turnover makes long distance being much easier to deal with. If I had multifamilies long distance, I would have to have more help, more costs associated with doing that. So just moving on quickly to why real estate is so good. Early in the conversation I mentioned, I think it's probably the best asset class to own. Why? So the reason is financing. You can go out and buy a 3 or 4 unit home with 30-year fixed rate financing. And that's really amazing. That's not even available in many countries throughout the world. In fact, I don't know if it's available anywhere in the world other than the US. So when you can acquire an asset with fixed rate loan for 30 years, can really help you generate cash flow over time.
My brother, how perfect was that timing? See that right? He finishes up over time. I come walking in, bang, biggity boo. Woo.
I don't think that was 2 minutes.
Was it? How was it?
I think that was less.
Oh, goodness. Brother, thanks for doing that. These dogs are nuts. Oh, goodness.
I didn't hear any of that.
So tell me, what did I miss, guy? Joanne, what did I miss? You don't know, but I had Joanne back here. She's wheezing. So I'm thinking it's got to be probably a challenge, right? I missed that whole thing because I was with the dogs, trying to get the dogs, but I have to think it would be a challenge to be owning out of state unless you owned enough and you had management companies doing it for you. But
yeah, listen, you can have a management company even if you own one property, but I don't have management companies for the most part because I've kind of just built myself a system where I manage things directly. But I mentioned when you stepped away with single family homes, you have a lot less turnover, so that they are easier to manage long distance. If you're doing short-term rentals, if you want to go buy a house on the beach somewhere and you're 5 hours away, that's different because you got a lot of turnover, right? Multifamily homes, people, and oftentimes they stay 1 year, 2 years. You don't get the 10 or 15-year tenant as frequently as you do in a single family. So multifamily homes, I think, compelling to own locally if possible. And again, even if you're not in the best market, your operational influence, your management, the way you can manipulate things and be involved in the management of those properties, it can really overcome, the fact that, you may not be in the city or town that has the best demographics or has the best job growth or things like that.
Now, I have to imagine too, once you have 1, 2, or 7 investment properties and you want to go and get your 8th, you could just show your portfolio to any bank and they just offer you to be a part of that? Or is it still a process when you are going and you're getting the next one? I mean, just so you guys know, Jason's also a mortgage broker. So this is not really a question for Jason personally, but it's just a random person off the street who's going for, loan number 7. They own 6 properties, own 7 properties, going to number 8. Do they just get anything at that point because they've got enough of a portfolio where any bank's like, okay, this is a real deal investor?
Well, not necessarily, probably not actually, not on the residential side. So I'm just a little mom and pop investor, right? I have residential loans. I do not have commercial loans. So it can actually get a little harder. I mean, for the most part, you have to be putting 20 or 25% down. And the underwriting process with a mortgage bank, they're still you still probably have to meet, well, not probably, but you still have to meet debt to income ratio requirements and have sufficient cash reserves and all these things. Now, you can do private mortgages, which can have a little bit more flexibility, but to your point, Mark, it can become a little bit more difficult to grow. And going back to what we said a few minutes ago, getting started in this business, it's difficult mentally, but financially, it's actually the easiest. So the first property you buy, you can do it with a very small down payment. It's properties 4, 5, 6 plus that become more difficult.
You need more money down when you become more of an investor. So up front, you can get in with a very small investment on your first investment, but beyond that, they start to hit you for your upfront payments.
Right. Well. So let me give you an example. So some people refer to it as house hacking. Okay, it's basically you buy a property as an investment, but you're going to live in it. So it's owner occupied.
Okay.
When a property is owner occupied, the data show that the default rates are much lower than a investment property. So for that reason, because human beings are much more likely to default on a loan for a property they don't live in, or their spouse or children don't live in, you get the best mortgage terms for a property where you're going to live. So what's a house hack? Particularly if you're a first-time buyer, you go out. This is a little difficult if you have a wife or kids or spouse, but you go out, you buy a 3 or 4 unit property, and you put 5% down. The terms of the mortgage will vary, but most are going to require that you occupy the property that's your primary residence for at least 12 months. So during that period of time, you can work on renovations, you can work on remodeling it, you're there, you're managing it, and it can be pretty compelling. So let me just give you an example. Let's say you have $100,000 in the bank. Well, what can you do with that money? You can do any number of things, but let's say you put $100,000 in the stock market. Well, you're going to buy $100,000 worth of stocks. But if you take that $100,000 and you put it into real estate at 20% down, 20%, which is the standard down payment, you're buying $500,000 worth of real estate. So you got $100,000, you buy $100,000 worth of stocks, or you buy $500,000 worth of real estate. Now, if real estate appreciates at 2%, that's effectively a 10% return, right? 2% on $500,000. So you'd be at break even if the stock market, if your stock portfolio went up by 10%. Okay, so stocks up 10% or $500,000 of real estate up 2%.
Okay.
So historically, residential real estate in the U.S. has appreciated at 2, 3, maybe 4%. So that's a realistic and somewhat even conservative hypothetical. Okay. Now, if you're house hacking and you only put 5% down, well, that's 25 grand. If you buy a $500,000 home and you put 5% down, that's 25 grand. I'm simplifying this. I'm leaving out closing costs and different things.
Yeah.
But let's just say you spend $25,000, you buy this $500,000 property, and it appreciates at 2%. Well, now you're talking about a return well above the norm. You could be looking at a 35 or 40 or 45% return on your money in 1 year. And of course, that doesn't include any tax benefits. It doesn't include any cash flow. So you only get a few of those silver bullets in your life: to live in a multifamily property, to acquire it with an owner-occupied mortgage with great terms, and then rent it out. So for anyone that's looking to get started in real estate, if you have the opportunity in life to move and to live in a multifamily home, that is the best way to get started. It's a silver bullet. You're only going to get that opportunity once, twice, probably in your life.
So your first time we could put down as little as 3.5%, but is your first investment property? Can you also put down less, or is it once you do that, or you're kind of bound to? I mean, you could probably always put down 5. The question is, you get hit with extra fees, I imagine.
Well, no. So you're right. On an FHA loan, you can put down 3.5%, and that's a primary residence, owner occupied. On a residential mortgage that is an investment property, you're really never going to be able to put down less than 20%. Some banks might allow 15%, but you're going to be paying a fairly hefty premium on the rate.
I see.
But again, so yeah, whether you do 3.5% on an FHA or 5% on another mortgage product, go into a multifamily for your first time, that's the best shot at, having a really high performing investment that could create some fairly significant wealth over coming years.
So right now, with what's happening in the marketplace, as you discussed and went kind of detailed for us earlier, that there is a limited supply of properties to purchase currently, which, the old saying, supply and demand. With the limited supply, the demand is through the roof. Prices have gone completely haywire. And so if you were out there and you were looking to buy a piece of investment property, you're kind of, unfortunately, you are a victim of the current circumstances that we're dealing with the supply and demand issue. And therefore, you're in the best position because you already have these properties working for you. But I think you really have to have a keen eye if you want to try to take a shot in this market, because once the bubble bursts, which we know it will, everything's going to go back to normal. I thought you couldn't sell a property in Connecticut 3 years ago. And now it's like everybody wants to go. And I'm like, okay, until they don't want to go, until they see the taxes or whatever. So I guess what I would say is right now, having the property already in your possession is probably probably the best position to be right now. But if you were going to get started, you really have to be careful, because some of these areas are overinflated. And I guess you really have to, and this is just me putting on my real estate hat, but you have to find a good realtor who's going to look at the market that was working prior to the pandemic, because that is where we eventually go back to. I mean, no matter how we look at this and we slice it, the market is only the way it is because they forced everybody into their homes. They made everybody wear masks, and and that's why we got to where we are today. When everybody, and they're sort of relaxing because of Ukraine, when things start to go back to normal and everybody remembers where they are and that they're okay going back to New York City, that type of situation, we're going to see a shift, I believe, in pricing. And I hope it's not going to be a major issue for anybody who wants to get in, and they bought up here as an investment and now it's performing here. Would you say if you bought here and it comes down here, you got hurt, or you could probably lock someone in for a lease during this period of time here and be okay, at least to cover yourself till that drop? Would you agree?
Well, yeah, I would agree to some extent. So With respect to real estate investing, you asked about break even, right? One of the reasons why I mentioned those 5 factors with respect to the economics around real estate, in my opinion, the most important one is cash flow. And if you purchase a property at break even, you have no margin of safety. So when we do go through a recession, to the extent that rents have to come down, you're now operating at a loss.
Yeah, makes
so
sense.
If you can buy right, which is not easy to do in this market, but if you can buy right, you can absorb a 5%, an 8%, 10% reduction in rents as we work through an economic cycle. The other thing that you need to look at, and why everyone's circumstances are so unique and every property is so unique, you can purchase something that's renting for X dollars per month today. But if you do your analysis and you do the work, you can say, I know that if I put in a new kitchen and a new bathroom, I'm going to be able to jack up the rent by $350 per month.
Yeah.
And that effectively allows you to build in a margin of safety. Now you have to do the math. How do you have contractors? Do you know people? Can you do some of the work yourself? How much is the new kitchen going to cost you? If it takes you if you can increase the rent by X dollars per month, but it takes you 10 years to break even, well, that's not a good investment. So I think, yes, we could see some softness in the market, but it really depends where interest rates go. There's a lot of different factors, and it's so local. I mean, real estate market, as you know, it's hyper local. So there could be prices, repricing in one market, and X miles away, things could look very different. So it really all just comes down to doing the analysis and doing the work.
So as far as the connection between stock market and real estate, is there a connection at all between the two that you would say where investors, and I know you said you believe that there's one of the best places to park your money is in real estate, but I did speak to a few people years ago that said they always believe that the stock market's a better place to put your money than in real estate. How would you explain to someone like that that's not the best answer, that there is that the reason you wouldn't put all of your eggs in the stock market is because...
I'm sorry, did you say you spoke to someone years ago that said the stock market was superior to real estate?
Yeah, and that they didn't see the benefit of going into the real estate market with their investing at all. Like I said, is there a changeover where the market gets so bad where you say, you know what, I'm going to take my money and put it in real estate? They said, no, never. And I just always thought that was weird.
Well, again, it really depends. I mean, with the stock market, let's just assume that you're not out there picking individual stocks and you're trying to be a hero or something. Mm-hmm. So you just invest in, like a broad stock market fund that you don't need to think about, right? It's pretty simple. No stress. It's kind of a set it and forget it type scenario. There's a lot of risk associated with real estate. I mean, you can be sued 9 different ways. You're dealing with very difficult people, I can say, to put it nicely. That's true. There's just lots of liability, and your interpersonal skills are going to be challenged. So that's something to consider. I mean, for a husband and wife, or for an individual that has a full-time job, focusing on their career may make more sense than trying to build a real estate portfolio. How do you value your time? What are your longer term goals? Are you going to want to spend a weekend working all day on Saturday and Sunday? Some people, yes, some people no. But specific to your question, Mark, I mean, what's better, the stock market or real estate? It can't be answered, because it's like, how long is a piece of string? You could make plenty of real estate investments that don't do as well as the stock market. You could also, the bar to outperform the stock market is not that high if you look at like a house hacking example. So back to my example where you buy a $500,000 property with only 5% down.
25 grand out of pocket.
25 grand out of pocket between appreciation, any cash flow, the tax benefits. You're building in an inflation hedge into your portfolio because you can raise rents in the future. I mean, it's almost tough not to do better than the stock market, which has a historical return, depending on who you ask, depending on what period of time you look at, between 8, 10, and 12%.
Now, just
Even
thinking
at the
about
high end, if the stock market hits 12%, if you look at a scenario like house hacking, it's not that hard to do much better than that.
No, now I'm starting to understand what you're saying. So say you took $25,000 in one hand and you brought it someplace and they're like, okay, here's 500 grand now with that 25 grand. And now you take that 500 grand and you clean it up a little bit so it looks like 550 or 600 grand. You go to a bank and you say, hey, I want you to give me money for this because I have a tenant in there. And now you got your I don't know if they give you it all or whatever they give you, but you refinance it and get, say, 500 grand in your hand again to go put towards the next property. You started with 25 grand though, and the bank just gave you 500. Is that all right?
So say that again, you're referring to taking equity out of the property?
Yeah. So you bought the property and you you got the house hacking thing going. You put 25 grand in. It's a $500,000 property. You clean it up. You rent it out to somebody. Now it's worth 600. You have the lease in place. You go into a bank and you say, hey, I want to refinance this place. And will they give you 600 grand for that? Or how does it work?
No. So at that point, if you were into it for 25, to acquire it, right, on the down payment. And then in your example, let's just say you spend X plus you experience some appreciation, and then the property is worth 600 grand. So you have $100,000 of equity plus your down payment. That's insufficient equity to get cash out.
I see.
But your idea is correct in that is how you grow your portfolio, as you create equity through through sweat equity, through renovations, through appreciation, through equity pay down. You can take cash out, lever up, and use those proceeds to acquire additional properties.
Or just another outside the box way of trying to make 25 grand into 100 grand or 200 grand. You could take 25 grand, you buy the property for 500, you clean it up and you sell it for 600. And now use 25 grand to make, well, you're still having to put the work in. You're not really making anything above and beyond the 25, right? I mean,
no, I mean, in that scenario, if you were, so people ask me about flipping, which isn't something that I have an interest in, or I think it's extraordinarily difficult. People watch these shows on TVs. I don't think it's realistic for most people, but I'm bringing up flipping because if you, in finance, people say you make money when you buy, meaning if you buy an asset for a great price, that's kind of when you make the money. Whether you sell it in 3 days or 3 years, you'll realize that gain. So in your example, if you bought something for a great price, and yes, you made some improvements, you could experience outsized returns if you sold it a year later. But back to the example of a 5% down payment, if you can find a decent deal, you can do so well that you can double your money within 12, 18, 24 months just on cash flow appreciation alone.
Really? Is that on a multi?
Sorry?
That's on a multifamily?
Yeah, well, so let's think about it. If you buy a $500,000 property and you're into it for 5%, again, I'm simplifying this. I'm not factoring in closing costs and stuff.
Yeah. That's
$25,000. So if the property appreciates at 2%, 2% of $500,000 is 10 grand. So, I mean, $10,000 on 25,000, that's like a 40% return. Right? So if you purchase and 1 year later the property appreciated by 2%, you've basically made $10,000 off a $25,000 investment. So that's like a 40% return. And I mean, if you were able to put any cash flow in the bank and you were able to experience a little bit of a tax refund because of the depreciation, because of the interest expense write-off and so forth, I mean, you could be looking at, it's fairly realistic to see like a 50% return your first year. So within a couple of years, you can be doing really well. That's why purchasing an owner-occupied multifamily, living in it for a year, any renovations, remodeling, work that needs to be done, oversee that and manage it. It's kind of like a silver bullet. I feel like everybody should at least do that at one point in their life, if they can, if they have the ability to do it.
I think that makes perfect sense, because you want to get the ball rolling and see if you could turn 1 into 5 or 7, you know? The opportunities there, I think that there's so much content for it right now, and people are very curious. That's why I really wanted to have you give me some insight on it myself, because I hear a lot of people talking about it. I just don't understand how you get going. But I think that what makes sense is you have to put a nest egg aside and find a good property that's going to yield something above and beyond a rental total. So if you're going to get, say, $5,000 total, you better be paying $4,000 a month, for that, something like that. It's going to give enough of a buffer, right?
Yeah, you have to do your analysis. You got to build a spreadsheet. I mean, it's not complicated, but you got to look at a subject property, find out what it's renting for, find out what the taxes are, what are the utilities, who pays the utilities? Do tenants pay or does the landlord pay? Who pays water? Who pays sewer? Estimate a reasonable vacancy expense and see what the cash flow looks like. If the cash flow is not interesting, maybe you can figure out, well, this unit's only renting for $1,000 a month, but all the other units in the neighborhood are renting for $1,350. So if I spend X on a new kitchen and paint the place and this and that, I'll be able to increase the rent. And then the property becomes more interesting. So you have to do that work. But to your point, Mark, how do you get started? I would say if you are younger and or single or your spouse is on board, particularly if you're a first-time home buyer, you want to buy a multifamily with a small down payment and live in it for a year or more than a year, but at least whatever period may be required to satisfy the mortgage terms. That is the single best way to get started. If you're married, if you have kids, if you can't move, which is totally understandable for a lot of people, I think then you simply want to save up the necessary money, which could be 20%, to buy a multifamily with a proper down payment.
Oh, I got one of those I have to sell. I'd like to buy it myself. It's I think you need something though that is not massive to start, right? I mean, you don't want to go into an area and bite off more than you can chew. You probably want to just get your feet wet to start, right?
Yeah, well, listen, I think if someone has a substantial amount of money and they can acquire multiple properties at once, yeah, you want to be careful about kind of what you're getting yourself into. You have to do a lot of research. What type of tenants are you inheriting? But for most people that are just looking to get started, I don't recommend anything less than a 3-unit property, because I've done analysis on hundreds and hundreds of properties, and it's just very difficult to get the numbers to work. 4 units, 3 units seem to work well. When you get to 5 units, you're technically in the commercial world, and 30-year fixed rate financing and low down payments are not available. So that goes back to why I think everyone should, at one point in their life, if they can, use this silver bullet of buying a multifamily as a primary residence with a small down payment.
Can you do that after you've purchased a regular single family home? Is that an option or no?
No, probably not. I mean, I mentioned if you're a first-time home buyer. So if you own a single-family home, why would you move into a lesser home, right? Because the multifamily really does truly need to be your primary residence. So if you don't own a home, it works. But if you live in a single family home
Going
and
backwards.
you make the case to the banker that you're going to, you and your family are going to downgrade your lifestyle, it doesn't look as though your intentions are necessarily in line with the terms of the mortgage. So you do have to satisfy the mortgage terms.
It makes a lot of sense. It makes a lot of sense. So what else do you think you could add about the market?
About the real estate market in general?
Yeah, I think where we're going, you think it's going to be a bubble? Do you think it's going to burst at some point?
Well, I don't know the answer to that. I think that I was kind of surprised how inexpensive real estate was prior to the pandemic.
Oh yeah.
Because you mentioned yourself, a lot of expensive neighborhoods in Westchester County, New York, and Fairfield County, Connecticut, and even beyond those areas, a lot of those homes, the pricing did not recover since prior to the global financial crisis in 2009.
Yeah.
In many other parts of the country, it had recovered. So again, real estate is hyper local. So it's, when you're talking about the whole country, speaking very generally, but interest rates now are at sort of like a 3-year high. They're probably going to continue to advance. That's definitely going to cool off the real estate market. It doesn't have to cause a crash. I don't see that happening, but we could see prices pull back a little bit. But even if prices pull back a couple percent per year over the next 2 or 3 years, so 2, 3, 4% for a year or two in a row, that's really just sort of a normalization after a massive run-up. I think U.S. residential is up something like 25% in the last 18 months or 2 years.
That sounds about right. I mean, people, they really pushed the market up quickly when they, and again, nobody really wanted to be in Lower Fairfield County 2 years ago, 3 years ago. Now it's just like the hot spot, but it's just because it's the flavor of the day. It's not in the city now, but I think people are going to flock back to the city, and we're going to see some issues here as far as trying to sell property again. That's my
well, I know here in Manhattan, a lot of people have, prices have totally normalized since the pandemic, and rental rates are, I think, again, depending on what type of unit you're looking at, a studio, a 1-bed, a 3-bed, rental rates are at 2019 levels. In some cases, they're above.
Wow. Yeah. I think that a lot of it is just based on the hysteria. But it also leads us to opportunity, and you got your mortgage broker license to add on to the back of your being a financial advisor, and share a little bit of the other things that you're doing, because you're extremely, tenacious when it comes to being an entrepreneur.
Sure. So thanks. I work primarily in wealth management, where we manage retirement assets, just long-term assets in the stock market and the bond market for people. That can be taxable money. It can be an IRA, a 401k. Mm-hmm. And, then my other focus is investing in real estate. And as you mentioned, I did get my mortgage brokerage license. So it's beneficial in a few different ways. It helps me understand better what my financing options are, the process, the mechanics behind it. And of course, it enables me to offer mortgage services to people that are looking to live in a home, of course, or people that are looking to acquire a home for investment purposes, or any type of property in the residential space, 4 units or below.
Let me ask, just the idea of being able to have the mortgage broker license, what you do is your background, and being in, the business of the markets. What about creating a property fund of some sort where we were able to purchase 30, 40 properties that are either renting out, just like we're talking about here, and then it becomes a line item on the exchange? Is that something that's even possible? How would you do that? You or us, or how would some individual go from A to Z in order to make that happen? Where you started your own fund?
Right. So I have thought about becoming a general partner. In what you described would really be a structure where there's a general partner that has the operating experience and who's on the ground acquiring properties, and the investors would be the limited partners. Now, what you basically described is a REIT, a real estate investment trust.
Okay.
And those are large pools of capital run by professional real estate investors. You can buy them in your brokerage account. They trade on the exchange. And I haven't looked at it in some time, but the definition of a REIT, you can qualify for tax status as a REIT with the IRS as long as the company pays out, I believe, at least 90% of net cash flow to shareholders. And that is how real estate is all about cash flow, as I mentioned. So many of these REITs are, they can be multi-asset class, they can be residential and commercial, some are industrial, retail, they have all different types of, specialties.
So they have those out and running REITs, they're out there. And if you wanted to create your own, it would just be a matter of getting some investors to back you, like you said, limited partners to back the
you
process.
can do it as simple as, two or three of us get together. I'm the general partner. I'm out there sourcing the property, acquiring it, managing it, running it, right? I'm the GP with X% ownership. And then everybody else, these 2, 3, 4 other people, it can be that small. They just provide the capital. They each contribute $50,000 or $100,000, right? And we just draw up an operating agreement for an LLC who has what ownership, create a financial statement, have a bank account. It doesn't necessarily have to be very complicated, but yeah.
I like that idea. That's, to me, that would be the way to build some sort of long-term equity, or at least an investment plan where, especially if you're working with someone that has a good eye for what is going to be pulling in money and always going to be safe in the long term when the markets turn. I think that's where the research comes into play, right? Where you really have to go in there and figure out what you're investing in, what properties they own, the cash flow of these properties, et cetera, in order to determine if it's safe for you to invest in it. I'm not sure, but would you say that probably makes sense? Do you do a lot of research when you're, about to invest in something like a REIT? Would you go into the woods and really look through there and see what's going on with the company, what investments they have? Is that how deep you get when you're going to invest in something?
Well, a publicly traded REIT, to some extent, but I personally don't invest in so on in my wealth management business, I don't typically invest in sort of single property REITs where you could, potentially experience significant losses if something were to happen to a particular fulfillment center somewhere. But yeah,
so you would do that for stocks, though. So if you were going to look into a mutual fund or something that you were going to invest in, you get and not just look on the surface of how it's performing. You would actually dig down the layers and see what's going on. Is that how it works? I don't know how it works when it comes to investing. I would imagine.
Well, it really depends. For the most part, I don't invest in individual stocks for many different reasons. I think it's very tricky. The data is very compelling that when you're trying to pick individual stocks and be a hero, it gets quite messy. There are other ways I try to outperform the market. I can use leverage, I can use options, and that doesn't necessitate my trying to pick the next Google.
Yeah.
So I think that makes a little bit more sense. But with respect to publicly traded REITs, not necessarily doing, the kind of research that you would do if you were going to go out and buy an apartment building, right? That's for the general partner to do.
Yeah, that makes sense. I love how you call it be a hero. That's the second time I heard you say that. When you go and you pick specific stocks, that's what it's called in your business, is like being a hero.
That's what I refer to it as, because
I love that.
It's largely unrealistic to consistently beat the stock market index, the S&P 500 or the Dow Jones or the NASDAQ, by picking individual stocks. It's very, very tough. If you watch the news, you hear people talk, you think it's easy to pick the next Netflix, but it's not. So I would rather focus my time and energy, for example, on real estate, where I know that I have a very high degree of confidence I can outperform the stock market. Whereas if the money that I'm investing in the stock market, I would rather, for the most part, see stock market level returns, as opposed to saying, I'm going to buy Facebook now, I'm going to sell Netflix now, I'm going to do this, I'm going to do that.
No, I think that makes sense, especially I ran into a buddy once who I went to high school with, and he said, if you just put your money in the S&P 500 or something, this is what he just randomly said. He said over the last 20 years, it's 10% or something like that. It's not always, but if on the average over the 20 years, it was 10%. Is that right? Just if you just put your money on the S&P 500 and just left it there?
So S&P 500 has been historically a great place to put your money. As for the 10%, it's right around there. Since the financial crisis, right? So since March of 2009, the return of the S&P on an calendar year or an annualized basis has probably been in the low teens.
Wow.
Maybe 14, 15%. It has been insane. It's been a fantastic period. It's been well above the norm, well above average. But, with respect to the 10%, that's more in line with the long-term average. But, the S&P was created in 1950 or 1955. So there's lots of different periods there that one can look to where returns seem extraordinarily high for several years, and they can seem not overly compelling for certain periods as well. So it really depends.
It's interesting. I remember Laura, who is my wife, she used to say, Jason knows that, but most people, I don't ever say her name usually, but she used to say, she'd get calls from people who'd be like, it's down. And they'd like upset that the stocks are down that day. And you wouldn't hear from them when they were up, but whenever it was going down, they'd blame, Merrill. They'd be like, oh, why didn't you tell us it was going down? That type of thing. And she'd be like, just wait, this is an up and down thing. It never is going to always go up. But I used to think that it was a funny thing to hear about the complaints you get when you are holding someone else's money and then it just goes the wrong way. They blame the person who's doing their best to try to make money for them. It's like the bane of my existence as a real estate agent. I do everything I can for the client, and then they'll make decisions on their own. They don't really care about how it affects the realtor who's been working their tail off for them the whole time. But that's the reality, the nature of the beast, I would say, right? I mean, you're holding their money, so you have to deal with some sort of the mental heartache that comes along with it.
Yeah, I would say so. But with respect to your example, if you are the steward of someone else's assets, right, you have to educate them on what to expect. So, and you have to have a system to do that effectively. And it's really primarily about communication. Now, you can be the best communicator in the world, and that doesn't mean people are not, certain people, depending on their personality type, aren't going to get upset when their account goes from $1 million to 900,000. But if you are communicating effectively, if you're managing expectations, if they understand what is going on and why, you can manage that much better. And you're not going to receive those as many, perhaps, as those types of phone calls.
Yeah. I think it seemed like it was always the same clients, if I recall the story. I mean, she hasn't done it in 15 years, but I remember there was one of the stories is like this one guy, I think it was one of those companies, like there was a film company that was working with you guys, like a big one. And like whenever the market was like, going the other way, they'd call and be like, why is our money not, I'm like, well, this is the freaking stock market. Yeah. I think that this is really compelling stuff to me as a realtor, but also as someone who's not very, very educated when it comes to the finance market and how things work, when it comes to mutual bonds and stocks, and when it talks about annuities, all these things, it's like foreign terms to me because I didn't study it. And I think that that's a real, I think that's a real negative for me because there's so much money to be made if I understood it. And I feel like I have to go to a class and just kind of pick up on what all those terms mean. Like, here's a good one I saw. Some guy was talking about shorting stocks. And he's like, oh, I put a put and all these terms. I'm like, I know I've heard, but what the hell does it mean? Like, what are we doing? Like, there's so much stuff that I just have never learned. And I feel like it's a good time to learn it, you know? It's a good time to learn.
You can just call me, Mark. You don't have to go to class.
That's so true. I'm just gonna be like, Jason, just take whatever. If I get I sell a couple properties, or when Renaissance Man finally gets recognized by the public, I'm gonna take that first check and give it to you, and you just say, Jason, you just figure out what to do with it. And just keep giving me that 10% compounded interest on a daily. That's a good one, right? 10 on a daily.
That'd be nice.
So I talked to you once about this thing, and I don't know if you've looked into it further, but it's called MPI is one of them, but it's called, I guess with life insurance, what you do is you're investing in life insurance. And then that basically is what I was told, or what I keep hearing, is that this is what the ultra wealthy do, is they create a trust. And within that trust, they create a life insurance policy. All the money goes into that policy. It compounds always. They could use it as a bank. Then they're the bank. They're their own bank. They borrow off that policy, off the money that they've put in, but the money stays in their compounding interest even though they've taken it out. It's part of their death benefit. So even if they don't put it back, it just comes off of what they're supposed to get at the end of their life. But you could put it back in and it will continue to add to what's compounding. But the weirdest thing is, if you had $100,000 in there and you took out $95,000 for an investment, there's still $100,000 compounding in there, even though you took 95 out, because you're borrowing off of your own money. It's the weirdest thing, but it's real. And one of them, like I said, is MPI, and the other one is called, I guess it's a specific life insurance that you have to invest in. But it seems to me like, because one of the things I keep seeing, this guy Curtis Ray, and he says, Roth IRAs, they only allow you to put X amount in each year. He said, you could put as much as you want into these accounts. You could borrow against them. You get compound interest on them. And the way he talks about it just seems like a no-brainer thing, but nobody really knows about it. And he even says it. A lot of people say people in finance don't even know about this because it's not taught to them. It's specifically kept for them. It's only life insurance people that have these specific products that know about it, and the ultra wealthy know about it. Is what's again, that's what the whole word around the street is. So with all that, have you seen any of it? Have you looked into it at all and gotten an understanding on it?
It's not something I'm familiar with, and I don't know a hell of a lot about life insurance.
Yeah.
So I can't speak to it. You did mention Roth IRAs. Yes, you can only contribute like $6,000 a year, but one of the things I like about real estate are the tax benefits. I happen to think that a Roth IRA, and by the way, many people would have access to a Roth 401k through their employer. Doesn't make sense for everyone. Depends how much money you earn, what your effective tax rate is. Do you live in a state with income tax, no income tax, etc.? But I happen to think that the Roth is one of the single best investment vehicles on the planet because you never pay tax again the rest of your life. I think it's an art. If you ask different investors, should you do a regular retirement account, a regular 401k, or should you do a Roth? You don't necessarily get a straight answer because you're making assumptions about the future. And for that reason, it's kind of an art. But I don't know about your life insurance product, but for anyone that doesn't have a Roth IRA or they're eligible for a Roth 401k, I think it's very, very compelling to make contributions. You can't contribute to a Roth if you earn over about 125 grand. So if you do, you simply make a contribution to a regular IRA, and you can do what's called a conversion, and you basically just transfer the money to a Roth. It's a non-taxable event. It's basically it's called a backdoor contribution for anyone that's not familiar with that.
That's pretty cool. Yeah, because he did talk about the Roth, and the difference they said is the payout that they work Roth off of won't cover most people, I guess, when you get to that certain age. But this guy was saying that the amount of I guess compound interest you're getting on the life insurance policy, which I said is somewhere like 10% a year, is like is what they're getting, something like this, and all of that winds up being. He was talking about the tax deductible income that you could be pulling off of X amount that you put in, and that Roth keeps you capped, so you can only get X amount once you do start collecting. But that this one is like you're not capped. So his point was the more you put into this, the more you can get back when you're 60, 70 years old. You could also retire at any point with this one instead of being like 65 or whatever. Does Roth make you retire at 62 or 65 in order to get it, or how's that work?
No, you don't ever have to retire, but IRAs do, you typically get penalized if you make withdrawals before, I think 59 and a half, it might be.
Okay.
But the vehicle that you're talking about, Mark, it might be some, fairly sophisticated estate planning tool, just
Probably.
something that I'm not aware of. I wouldn't be surprised if it does not make sense for a lot of people.
Yeah.
But
Yeah,
I can't speak to it. So
I think you got to have disposable income is what it sounded like to me. Like you've got to have, instead of putting 50 grand into the stock market, you put 50 grand into one of these funds and you just let it sit there. And then when you need to go and do a renovation, you just borrow from your own money while it sits there and continues to collect compounding interest. And the philosophy was, if you put $300 a month into one of these accounts that's collecting 10% a year, and you leave it there for 40 years, you have $1.8 million in the bank only after putting $42,000 in. So the compounding interest thing, was it Albert Einstein said that that's the eighth wonder of the world, is compounding interest?
right. But you said after 40 years?
I think so. Something $300 a month. It was again something I watched on the screen, so I don't know how accurate it was, but they were putting $300 or $400 a month in for 12 months for 8 years, and then at the end of 8 years, they took that total, which was something like $42,000 or $48,000. They multiplied it by that 10% of compound, and they came up with this is a Tony Robbins thing, who was saying, he was telling his kid how to turn $30,000 into $1 million. And he talked about doing the compounding, the power of compounding. So I think this is stuff they don't teach us in school. You have to specifically go to, you have to go into finance, I think, to learn about this. They should teach people more about the power of compounding in school instead of whatever the heck they're teaching,
Well, that's it's a whole nother discussion that I completely agree with. I mean, the importance of financial and investment knowledge it's a paramount, and people come out of the school system in this country, not knowing anything about their credit score, how it works, why it's so important. So yeah, I agree for sure.
It's not only that. I think about it, like from all aspects of finance, of entrepreneurship, they don't cover it all. It's very odd. They're like, let's go through a textbook. Let's talk about Magellan. And it's just, what is the point of this entire charade? I think, here's the thing. This is getting into the woods a little, but they say that the entire process of 9 to 5 schooling or 9 to 4 schooling was about indoctrinating people to be okay with going and working for somebody. They wanted to create a slave force, so they did it with the school system. Get people to be okay to stay in a school system and be taught things all day that do nothing for their future. And then you get them okay to go stand in line and not rebel against some boss who's calling the shots. And it's kind of what we did fall in line when it comes to it, because most people are okay with getting the terrible schooling and then learning that they realize nothing until they start to learn some specific topic that's pointed in the future. But we're kind of all lost and wandering until then. What do you want to do with your life? Well, I don't know. I was taught all this garbage in school. None of it means anything. And now I have to pick a major. It's really interesting. Yeah, you pick up some good stuff. Don't get me wrong. But I think a lot of what they teach you does not benefit you in life 2022.
Yeah, without a doubt. I mean, listen, school, even for a lot of the subjects and the content that you may learn that doesn't have any real application, it can still help your brain develop, particularly as a child or a young person. But, again, given the importance of understanding some basic financial rules and how to build wealth through the stock market, how to build wealth through real estate, how to acquire assets, your credit score, all these things. I mean, the fact that you can go through the whole system and not know any of that, not be taught any of that, to the extent anyone is familiar with that, they took the initiative themselves, or they were fortunate enough to have some type of mentor or family or parents. But in the absence of that, the school system really does nothing in terms of helping people or setting them on some type of path directionally towards creating wealth.
Yeah, no, I agree. I think there's a restructuring that needs to take place, especially now with the price of colleges, and there's no return on that investment that I could see in this day and age. You know, spending, what is it, some $250,000 to go to school, and you're working at Home Depot or something. You know what I mean? There's no jobs out there, or even if you're getting a decent job, you're not paying off those bills. You know. We're really backwards. Think about what we charge. Like, these are all private universities, so they could charge what they want, but they really, the inflation thing is not helping, obviously. Totally nuts. Listen, we could probably talk about 50,000 subjects. I don't want to keep you on too long. This is an absolute pleasure having you on, brother.
Hey, thanks for having me on, Mark. Great to see you.
Yeah, man. Listen, we gotta go do another update soon about, when you can, at some point, if we could ever talk about strictly maybe the stock or the mortgage market, talk about rates and how that affects people. Because what I think is going to happen, this is just mark my words, but the buying power of everybody's going to be affected by the rates going up. And that's obvious. But what we're going to see is that's going to scare people. So the people that are out there spending, splurging, throwing their money left and right, as soon as those rates get to an unmanageable height for them, I mean, remember, when we were kids, our parents were paying like 18%, you know? So this is something we can't even comprehend, something like that. But I paid 6.75 in my first house. And these now, what are we at? 3.75, somewhere in that range, 4?
We're around 4. Well, as of today, we're probably over 4%.
Okay.
On the average 30-year rate, but
so around 4% right now, which is still historically lower than the history of time, except for the last 3 years, we were lower. Okay. Right now would be the time to lock in if you were going to out there to buy something, because they're going to go up to 5 or 6.75 again. They'll be at 6.75 before you know it, because that was a decent rate when I got it. When I got 6.75, we were pumped because they were just at 7. You know what I mean? I was like, I got 6.75. You know, we were there for 6 years at that rate until I realized I should refinance. But that was a good rate at the time, and I know some people that got in the 2s during this run. You know, good for you.
Yeah.
You're able to get, that's why I always say, if you're going out there and you're going to buy something, and if you can use the bank's money because it's cheap, this is the time. You know, if you put some reserves away and you could pay cash one day when it's 9-10%, then okay, then that's why you saved up the cash, you know. But who knows? Lots, like I said, lots we can discuss next time. But I appreciate you, brother. Thanks so much for your time tonight. And hopefully we'll see you around the chat sometime soon. It's a slow night tonight, but I'm glad you're here. Now the replay, people will come back and at least see some really great tips you gave us tonight in order to invest in our first property.
Hey, great to see you, Mark.
My brother. Thanks so much,
Talk
okay?
soon.
We'll see you
All
soon.
right, man.
Guys, Jason Arena, the man, the myth, the legend. Let me just shut the Zoomer down. Zoomer is down. Let's see. And we're back. That was awesome. You know, I've been thinking about investing in a piece of real estate for a while. Like, I just, as a real estate agent, I see properties all the time I want to invest in, but I never know what is the right property. I never can get a feel for how to get the cash together to take it from idea to renting to somebody and then taking that property and refinancing it and going and buying another one. I hear about people doing it, but that's why I say I think that first one is the most important one. You need to get that going. And once you get the ball rolling, you get your feet wet, you taste a little bit of that success, then you get motivated, you get the confidence building a little bit more, and you could do something. You really do something with it. So that was really awesome. I want to thank Jason again for being on. And guys, if you do need any mortgage assistance, or if you're looking for someone to invest your money with, Jason's your guy. I mean, it's it's nice to speak to someone who's so knowledgeable in a topic that I have no idea about. You know, like it comes to finance and it comes to, you know, like I said, annuities and all these terms I've heard. Oh, the derivatives. Guys, there's a derivative. I'm going to do a derivative thing, you know. Pamela, you're right. He makes it sound so simple. I mean, when I worked with Jason and he was buying that property, like, this is why I really wanted to have him on. He was so detail oriented. He knew everything down the line. He had a checklist on what he's looking for and make sure he got X, Y, and Z so he can make his decisions and not make mistakes. And I think that's important. You don't want to make mistakes when you're on your way in. He said something important. You make your money on the way in. So if you find yourself underwater because of that purchase price, you're going to be in for a rude awakening. Oh, goodness, guys. So I did plan on maybe coming back a little bit later on. This was supposed to be a shorter show. Just come on with Jason and do an informative live money matters thing, whatever. Live money live, whatever we call it. With the Chooch, whatever his name is. Man, I'm having a tough one today. Kramer. When you got a Kramer deal going. But I got to get some coffee. I got to eat some dinner. And I'll probably be back later around 10:30, you know. So I hope you guys will be back to join. Share the show so people could see the wisdom of Jason Arena. And hopefully we'll have a chance to bring him back on in the near future to get an update on the real estate market when it comes to the mortgages, etc. So, fam and friends, just in case I get caught up, I'm trying to get the comb over bit done for you. It's almost done. So make sure you guys pop back in later. I've been dropping shorts like a mo. Check those out. Give it a share. And remember, fam and friends, I will hopefully be back later. If not, I'll be back someday. Tomorrow. Maybe the day after. I don't know. Maybe I'll take tomorrow off. Joanne, am I taking tomorrow off? What? Joanne? Joanne said, no way, Jose. She's a silly goose. Oh, goodness, fam. So, when I get back later, we'll do something. William, Pamela, most likely something. We'll see. Till later. It's Mark Pires. And it's Renaissance Man. I love you guys. I'll see you later. You got to go.